Hey, welcome everybody. Yasin Nizami here, back with another video on the global macroeconomics. In this video, we are going to talk about the relationship with the GDP growth, the money supply, and the inflation, how these things are related with each other, and what we have seen throughout the 200 years of data that we have so that we can predict what's going to happen in the future. And all these rapidly changing economic times, how this is going to affect you and I in terms of our financial, well-being, that is going to be significantly impacted as a result of those changes. So if I share with you my screen, and what you can see here is the chart showing the government spending and the revenue as percentage of GDP. This is US, by the way, so it's not global, it is US specific. And what it tells you, the data all the way goes back to 1800s. And what you can see that there is a clear trend of growth of debt to GDP. Okay, so but there's the growth has only started to happen like since the 1940s, since Second World War. But before that, you can see up until like 1916, which is the First World War time, that trend has been somewhat, stagnant. I mean, it went up, since Civil War, which was back in 1860s, then it came back. So all of these big spikes, this is showing the war time where, of course, the spending goes up because it's war, but then it comes back down as the war is finished, right? But you can see all the way from 1792, where the data has been collected, we can see a pretty straight line up until like 1918, when the First World War started. And since then, it has been on an upward trajectory. So what it shows you, and this data is only goes to like 2018. So we don't have the pandemic spending, which will of course look like a balloon in this chart. So, but we can see that there is a clear trend of GDP, debt to GDP growth. So if the GDP is growing, we're seeing the debt, the government spending has been growing along with that. And if that trend tells you something, is throughout the 200 years of history, we haven't seen the government spending decreased or dipped, outside of the wartime. Yes, war is exception. When the war starts, the government spending shoots up, but then it comes back down as soon as the war is finished. But outside the war time, we can still see the government spending has been increasing and growing over time, right? What we also want to see here is, let's start with this chart first. So this chart is showing you the correlation between the money supply and the inflation, okay? So one thing to note here is you can see both of these things. So the red line is CPI and the black line is M2 money supply, US data only, okay? It's not global. And what we see here is as the money supply goes up, inflation doesn't go up with that at the same time. So there is a lag effect, which we always talk about, and the central bankers are also now talking about that. There is a lag effect where when you inject the money supply, it doesn't create the consumer inflation at the same time. You can see the immediate impact in the asset markets. You can see the stock market, equities, crypto, real estate. That takes the effect immediately, but the consumer market takes time. So even if you focus on the last, let's say, 20 years, we can see in 2020 when the money supply went bananas, way up like on a hockey stick, the inflation doesn't go up along with that. The inflation started going up when when the money supply peaked, which is around January 2021, yeah. And then since then, the inflation started going up, okay? So there is a lag effect where the money supply takes time in order to trickle down in the economy before we see the inflation becomes visible in the CPI figures. So that tells you one thing, and I think it is trending down. As you can see, the money supply, came down from its peak. I think it goes down below the levels of what we had in 2019. So that tells me that inflation is also trending down, and it's going to come down within the next few months, okay? So that's a news for us to track, how Federal Reserve is going to see this data in terms of their next rate hike. What this chart is telling you, let me just reduce my videos feed here, is the correlation between M2 money supply, CPI, and GDP. Okay, so and this data goes back to 1800s as well. And during those times, we can see the money supply has been increasing, right? So we can see, especially from 2008 onwards, when the GFC, we had the GFC, which is global financial crisis. You can see the money supply has been constantly going up. Before that, it was going up, but at a slower pace. Its pace in terms of getting increased has gone bigger since 2008. And there was a dip in the GDP here. So if I just move this along here, so I was measuring since 1980. So this is the data from 1980s all the way to right now in 2020. So we can see that pretty much it was going up, but it's not at a level we have seen in the last 20 years. But right after 2008, the global financial crisis, we can see the money supply has crossed the rate of increment in the GDP. So before that, you can see the GDP blue line has been, so if I go back to 2000, you can see that the money supply and the GDP has been tagging along with each other. So that's what Keynesians believe. So Keynesians believe that it's okay to take debt in order to stimulate the economy, because at some point in the future, the debt will create enough economic growth in the form of GDP, which will allow government to collect more taxes to pay off that debt using deflated dollars. Okay, so this is what Keynesians believe, and we can see that the money supply and the GDP has been tagging along, and since 1990s, we're seeing that the GDP growth has surpassed the rate of change in the money supply. But that is not exactly true right now. So this is between 1990s and 200. So if I go back to the recent times, let's say from 1990s to 2000, we can see that since 2008, which is the global financial crisis, the money supply, the rate of change of money supply has crossed the rate of change of GDP growth. And since then, the delta between the percentage change of money supply and the GDP growth has been getting wider and wider and wider. And now we can see there's a big delta in terms of the rate we are injecting the money supply or increasing the money supply compared to the rate we are producing GDP growth. So in my previous chart, where we saw that the trend of government spending has been constantly increasing, and there is no way that we can see that this can come down. It will be a miracle if we see the government spending come down overall. And this chart shows that even the Keynesians believe that taking debt is okay to stimulate growth, because the growth will give you enough tax dollars in terms of taxes to pay back that debt using deflated dollars. But what I'm seeing here is there is a threshold. People believe that as you go above 90% of your debt to GDP, it really becomes impossible to pay back that debt. And as the debt grows, you're producing more goods and services to create GDP growth, but at the same time you're increasing more debt. And when you increase more debt, it increases the inflation. And inflation will also have a direct impact on the GDP, because when the prices goes up, the spending also goes up, right? So the tax dollar also goes up and GDP grows along with that. But at the same time, the government is also paying back the interest payment in order to service the debt. So it's like, the dog eating its own tail, right? And when you're injecting money by taking more debt to create artificial growth, but at the same time, you're also spending that money that you're recovering in order to pay back the debt or servicing the debt in the form of interest rate. So my point here is the history shows us that when you have surpassed a particular amount of debt to GDP, which is like 90%, there is no way to come back and then reduce your debt level. Okay, Even if you go into the deflation, this will also reduce your tax revenue because the spending will be reduced and you won't be able to collect a lot of tax revenue in order to pay back the debt or service the debt servicing cost. So this whole thing tells you one thing, that this system is entirely unsustainable. At some point, this will collapse because you cannot pay back that debt. The debt to GDP ratio has been widening. Okay, so the GDP growth is growing, but at the same time, the money supply is growing at the same time. So you cannot um, get enough revenue to pay back the debt. So this whole idea about build back better, great reset, it started to make sense because at some point this system is going to collapse, and then the new system will emerge and will replace this. Me, as a common person, is thinking, okay, what will happen to my wealth if this system collapses? Because my wealth is depending upon this system in terms of stock investing, real estate, on mortgages, or even whatever cash I have in the banking system. It's all tied up with this system, okay? And if this system collapses tomorrow, I should have a plan B to get myself protected. So what do? I'm thinking myself is to buy some assets outside of the system in the form of Bitcoin, gold, or real estate purchased on cash without mortgage. If it's on mortgage, it's still part of the system, right? But if you have anything outside of the system, even if the system collapses, you still own something that you can leverage and use it afterwards. Again, this is some theoretical analysis, but that doesn't look far from reality by looking at this data. So let me know, what do you guys think? Put your comments down below and I'll see you in my next video.